Investors have a wide array of investment choices. Besides trading individual stocks, which offer a share of ownership in a specific company, investors can select from mutual funds and exchange-traded funds, ETFs, that give them access to virtually every corner of the financial markets. ETFs are collections of stocks, bonds, or other investments that are traded on an exchange. You want your investments to perform well. Each investment instrument brings its own unique set of benefits and disadvantages. With so many different choices, many investors find it hard to decide what exactly to invest in when choosing between stocks and ETFs. It's important to know the differences and nuances of each to make an educated choice that aligns with your investment strategies. In this episode, you will learn the differences between ETFs and individual stocks in order to make an informed investment decision. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos about the best stocks to buy. The answer depends on a number of factors, but before we dive deeper, let's quickly walk you through individual stocks and ETFs basics. Individual stock basics. When you own an individual stock, you own a piece of one company. It's up to you to decide which companies you want to invest in, and you're the one who determines when the right time is to buy, sell, or hold. If you have a keen investment sense and do your homework, you might be a successful stock picker. Some stock investors get a rush from picking a good stock, the way a gambler does when he hits a jackpot. If this describes you, then you probably want to pick at least a few individual stocks and see how it goes. ETF basics. ETFs are investments composed of a basket of stocks that trade like regular shares. The original ETFs mirrored one of the stock exchanges, like the Nasdaq or the Dow Jones Industrial Average. Nowadays, there are ETFs that invest in a wide variety of market sectors, in addition to those that are linked to an exchange. They're similar to mutual funds, in that their shareholders have a fractional ownership in a set of stocks. Mutual funds, however, are valued just once a day, at the market close. ETFs actively trade throughout the day and can be bought on margin or sold short, just like individual stocks. There are also ETFs that invest in bonds and commodities. Now you know what individual stocks and ETFs are, let's take a look at the differences between ETFs and individual stocks. 1. The risks. Investments can be volatile. Many factors affect investments. Company executive turnover, supply problems, and changes in demand are only a few. Investments also come with inflation risk, which is a loss of value due to the decrease of value in the dollar. Other risks are interest rate risk, which affects bonds, the risk of rates rising, which decreases the bond's price, and liquidity risk, which is the risk of not being able to sell an investment if prices drop. The volatility of a stock is measured using a metric called its beta. This is a comparative measurement used to indicate the volatility of a stock based on the market it belongs to. An ETF is slightly less risky because it's a mini portfolio or basket of investments, so it's somewhat diversified, but it really depends on what's in the actual ETF. If you were to invest in an oil and gas ETF, you would assume nearly the same risk as purchasing an individual stock. However, ETFs might overcome this by spreading their holdings out around the globe, holding natural gas as well as oil stocks, or diversifying the basket in other manners with a hedging strategy. 2. Diversification. Diversification is an attractive feature of ETFs. Instead of taking concentrated risk by purchasing individual stocks, investors can own an index of stocks with ETFs. Owning individual stocks has special risk and often requires diligent attention. In addition to reducing market volatility, many investors have cut their commitment to time-consuming and expensive stock research. By over and underweighting ETF industry sectors, for example, investors can obtain an optimal allocation that suits their financial goals. 3. Leverage. Like individual stocks, ETFs can be leveraged with margin. Margin is borrowing money from a broker to buy securities and involves considerable risk. Minimum maintenance requirements are enforced by the NASD, National Association of Securities Dealers, the NYSE, and by individual brokerage firms. While margin investing can be profitable for investors that understand the direction of their holdings, the interest charges or borrowing costs can deteriorate returns. There are a multiplicity of option strategies with both stocks and ETFs. Purchasing call or put options is an aggressive technique. An option investor can control a large amount of ETF shares by paying a premium. The premium price is a fraction of what it would cost to purchase the shares in the open market. This provides an options investor with a great deal of leverage and a high risk-reward opportunity. A more defensive approach uses put options in conjunction with portfolio holdings. Buying protective puts on ETF or stock positions would ensure a portfolio against declining prices. There are many other tactical possibilities with options. 4. Market exposure. Individual stocks make it easy to focus some of your investment dollars on a specific company that you believe in, one that is usually well managed or innovative, for example. The many different types of ETFs offer investors simple ways to get broad exposure to different markets. Many ETFs are designed to track the results of indexes such as the S&P 500, for example. Others focus on business sectors, such as technology or energy. Some follow specific strategies, such as growth or value investing. Unlike stocks, however, you can't use an ETF to focus on a single firm. 5. Liquidity. Liquidity refers to how easy it is to convert stock or ETF holdings into cash or another investment. With stocks, it will depend on the corporation issuing the shares. If they're a recognized financially stable, high-quality stock, also known as a blue-chip stock, you'll have no problem trading shares. On the other hand, penny stocks may take weeks or days to trade, if you can at all. ETFs are nearly as liquid as stocks for the most part. Again, it will depend on the quality of the products the ETF carries in its basket. The fund's trading volume will also impact liquidity. 6. Research and legwork. If you're a stock investor, you have to do all the research and trading yourself. Some investors welcome this, but others may find it too time-consuming or difficult. ETFs are professionally managed based on the goals outlined in the fund's prospectus. All the work of researching, buying and selling individual stocks is done for you. ETFs charge investors a fee called an expense ratio for these services. Of course, you must decide which ETFs to buy, so there is still some research required. 7. Control over investments. Individual stock investors make decisions about exactly where their money goes and which companies to invest in. Some investors welcome this direct control, others may find it too time-consuming or difficult. However, ETFs are professionally managed based on the goals outlined in the fund's prospectus. The managers do the work of researching, buying, and selling individual stocks. So, which is a better investment? Whether individual stocks or ETFs are better for your portfolio depends on your goals and risk tolerance. For many investors, it can make sense to use ETFs for a long-term retirement portfolio, where diversification and reduced risk might be more important. For those hoping to capture value and potential growth, individual stocks offer a way to boost returns as long as they can emotionally handle the ups and downs. For beginners who have a small amount to invest, starting with ETFs and making regular contributions can be an effective way to build a portfolio. Later, after becoming more experienced, consider branching out into individual stocks. Carefully consider your goals and use investments to create a strategy designed to help you get there. Stocks represent shares in individual companies, while ETFs can include hundreds or even thousands of stocks, bonds, or other assets. You don't have to choose one or the other though. ETFs and stocks can both be used in a portfolio to help you grow your wealth and meet your financial goals. Carefully consider how each might fit your needs and personal investing style. That's it for this episode. Please give us your feedback in the comments section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.